Look, I get it. You love your family, but did you know the primary benefactor of your retirement accounts is not your spouse? It's not your children. It's not even your favorite charity. Good old Uncle Sam is. And he's taking a bigger bite out of your retirement income than you'd ever expected. Higher taxes, forced withdrawals, unexpected costs. It's that silent partner that you never planned for. Thanks, Uncle Sam. This is reality for many retirees who didn't know the impact taxes would have on their savings. And the scariest part, one client told me she felt like the government has lied to her all these years. It can sneak up on you, reducing the income you need for everyday life, rising healthcare costs, and even the legacy that you hope to leave behind. But you can start to disinherit Uncle Sam. Today, we're going to break down secrets to managing your tax buckets: taxable, tax deferred, tax free, so you can keep more of what you've worked so hard for and avoid these surprises. So, whether you're entering retirement or already there, this could be one of the most powerful strategies to protect your future. Stick with us because we're diving into key strategies every retiree needs to know to keep their hard earned money out of Uncle Sam's hands. Welcome to Retirement Rescue Weekly, where we throw a lifeline to your financial future. This podcast is dedicated to helping rescue retirees from potential dangers that appear in retirement. I'm Kurt Arnold, your host and financial advocate. I'll guide you through the stormy seas of retirement. We'll tackle inflation, taxation, market volatility, and healthcare costs. Together, we'll secure your retirement. Tune in and start your rescue mission today. Well, hello and welcome to another edition of Retirement Rescue Weekly. I am Kurt Arnold, your host and financial educator. Thank you again for giving me the opportunity to teach today. And before we jump into today's show, I want to just take a moment to recognize our veterans across the country that have served for us. Thank you for everything you've done. I don't think we can thank you enough. Really appreciative. I have family members, friends, coworkers that have served, and really, really thankful for all that you do. So that being said, let me do my part to try to help those that are out there rescue you from these different things too. And today we're going to talk about taxes. Now, taxes was a hot topic during the election campaign as we had different opinions on how that was going to go. One of the things I mentioned in the open was one of my clients said that she felt like she was lied to by the government for all these years. Now, if you remember back, a lot of times people had pensions. That was like a normal thing. Your company would save for you. They'd take a percentage of your check and maybe the company would contribute. And then they would manage that for you. And then if you worked however many years, there's a formula and they would be able to figure out your retirement income with that and then Social Security on top of that. Well, at one point in time, it became too hard and too expensive for companies. So they started getting out of that. And really, most companies don't have them anymore, except for government jobs, federal jobs, things like that. So then what they said is, hey, we want you to save into a 401k, which is part of the tax code. Now, the 401k is tax deferred. So if you save into the tax deferred, it will lower your income. And then when you're in retirement, you'll have lesser income. So it'll work itself out and you'll have lesser taxes. Well, that didn't work out that way, obviously. Now taxes are higher. They could go up even more. And you'll learn more as we talk more about this too, how even having RMDs come out at the wrong time can really drive some issues in retirement. And so that's where she felt like, hey, I did what I was told, but this isn't working out the way you said. So we're going to talk today about how we can actually help us pivot away from some of these things that are hurting us right now. We're going to talk about a tax efficient retirement, understanding these tax buckets, and whether you're working or retirement, how important it is that we understand how these tax buckets work. So Warren Buffett, I think everybody kind of knows who he is. He's one of the richest men in the world. He has a quote that says, "It's not what you make, it's what you can keep." And I say that one a lot because it's so important when it comes to taxes. I remember sitting across the table from a lady she was feeling pretty good about herself. She's like, I got $1 million in my 401k. I'm good. And I had to tell her, you don't have $1 million. She's like, yes, Kurt, I do. And she's sitting there pointing at it like, look, it's right here. I'm like, no, you don't. It's a tax deferred asset, the 401k, which means you have not paid tax on that yet. So when you take that money out, now you're gonna have to start paying tax on that money. And it's not going to be $1 million. It's going to be less. It's probably closer to 750,000. And let's hope they don't raise taxes even more. And so that was an eye opener for her. She thought, hey, I'm good. I got $1 million. I read some articles online. I'm good. And she didn't realize the tax part they have a significant disadvantage for her, as well as affecting some other things, which we'll talk about today as well. Uncle Sam, we just got through election season. We talked a lot about approval ratings. I think Uncle Sam's approval rating is probably about 0. Now, in reality, the actual real Uncle Sam that everyone talks about was actually a really good guy. But the personification of Uncle Sam that we see of a lot is related to taxes, and people don't like paying taxes. So his approval rating is not too good. So what's the big deal about taxes? Why does it matter so much? So, originally what taxes are meant for is to fund programs to benefit individuals, Social Security, Medicare, welfare, things like that. We're paying in our paycheck as we do things and as we're working to help fund these organizations. Obviously, our country has a spending problem, so some of these things are not working out the way they were supposed to. For an individual, tax efficiency is really important. If you are tax inefficient, which means we have a lot of tax burden when we're taking money out of our retirement accounts, it can have a huge impact on longevity, which is what most people are worried about. Will I have enough money and will it last? And so that's where we have a significant issue for retirees. And that's why there's a lot of anxiety and stress, because I didn't think about this part, taxes. So what we're going to do is we're going to teach you to help you understand the 3 parts of the tax code. Essentially, I always joke with people like, hey, did you do your homework last night? Did you read the entire tax code before you came in today? And they look at me like, what? I'm like, yeah, 3 million words. That wasn't a big deal. And they're like, no. I'm like, don't worry. The people that wrote the tax code probably haven't read it either. But we're going to summarize the 3 big key parts of the tax code where your money can be invested: taxable, tax deferred, and tax free. And we're going to start with while you're still working, so you understand how those buckets work when you're contributing to your retirement accounts. And then we're going to fast forward later in the show. And we're going to talk about now when we start taking money out, what's that look like? Let's talk about the 3 different tax buckets where you can stash your money away for retirement. We have taxable, tax deferred, and tax free. Each has its own unique rules on how it's taxed, how much you can contribute, and how you access it. Let's start with the taxable bucket. This bucket is for accounts where you pay taxes on earnings every year, whether you use the money or not. Examples of this may include your regular savings account, brokerage accounts, and CDs. There are no limits for how much you can contribute into these accounts. So when you contribute here, you're already paying income tax on that money, and every time it grows through interest or investments, you'll pay taxes on those gains. Next up is the tax deferred bucket. This one is very popular for retirement, like traditional IRAs, 401ks, and 403bs. Here's how this one works. You contribute pre-tax money, meaning you don't pay taxes now. It actually lowers your taxable income. This money grows tax deferred in the account, and then when you take it out in retirement, that is actually when you'll pay tax on it. Another thing with this account, it's typically where your employer will also give you an employer match to help contribute for your retirement as well. Now, you can contribute up to $23,500 a year in your 401k. Once you're between the ages of 50 to 59, you can contribute an additional $7,500 per year as a catch-up contribution. Now, new this year is a super catch-up period between the ages of 60 to 63, where you can contribute $11,250 per year. And then back at age 64 and older, it goes back to $7,500 per year as an additional catch-up contribution. If you're contributing to an IRA, it's $8,000 in an IRA if you're over the age of 50. Generally, you'll need to wait until 59 and a half to avoid a penalty when accessing these funds. Finally, we got the tax-free bucket. Here you pay taxes on your money up front, but then the growth is tax-free as long as you follow the rules. This bucket includes Roth IRAs, Roth 401ks, and cash value life insurance. The beauty of the tax-free bucket is that in retirement, you can withdraw money without paying any taxes on it. For a Roth IRA, you can contribute up to $8,000 a year if over the age of 50. And as long as you wait till age 59 and a half and have the account open for 5 years, you won't owe a dime in taxes. One key to understand with Roth IRAs is that they do have income limitations. Individuals must be under $150,000 of income to contribute, and married filing jointly under $236,000. So there you have it, our 3 tax buckets. Each one has a role to play, and diversifying between them can help you keep more of what you work so hard for to use in retirement. All right, so I hope you can understand why it's so important to understand the tax buckets while you're working, because where you put your money, that's where it's going to grow, and that's how it's going to get taxed. And also, it has some determinations about when we can access it. So again, kind of just a quick recap. Again, that taxable bucket, savings accounts, CDs, brokerage accounts, mutual funds, things like that. Tax deferred, that's where most of our employer plans are going to be: 401ks, SEP IRAs, simple IRAs, 403bs, 457s. If we move those out of those employer plans into a IRA, that'll be there as well. So that money has not been taxed yet. And then a Roth 401k, Roth IRA, and then some other tax-free things we can look at too. But typically, a lot of people have their money here, which we'll show you a little bit later too. But again, just being more aware of these tax buckets can help us as we look forward. So as we're looking at these different tax buckets while we're in our working years, why do we want to invest in the taxable? Well, it gives us some flexibility because we can actually put money in and invest it. If it's something we don't need it for a shorter timeline, we can put money in it and grow it. And then down the road, maybe in a couple of years, we have more money we can use for some different financial goals. No contribution limits here at all. So you can literally drop in $200,000, $300,000 a year in here if you had that. Whereas, employer plans are going to have some limits. Roth IRAs may have some limits. So here's where you can drop a lot of money in if you need to. Capital gains treatments. So right now, the capital gains tax rates are more favorable than the ordinary income rates right now. They are looking at changing this. President Biden's tax plan, if he was reelected, was going to increase the highest part of this to as high as 44.6%. Kamala Harris was looking at getting rid of having unrealized gains get taxed. So it's something that's on their mind, and you always have to be aware when they mention things. There's a reason why they mention it, because they want to see what the reaction's like and see is it something that they could actually get passed, but it could get taxed more. Now, again, some benefits: liquidity. We can put money in, but we can still access it. Whereas a lot of the other ones we're going to talk about, the retirement account ones, we can't access till we're near or in retirement. It gives us some diversified income, useful for early retirement. So this is one of the places where if you are trying to retire early, like I had one person that retired at age 55, you can't touch the IRAs or 401ks or Roths, things like that, to 59 and a half. So this is where you need to start pulling money from. And obviously Social Security and pensions might not start right away either. So this is one of the places where you have to pull from. So this is where that would be a key if you're going to retire early. Now, the things we have to be aware of, we will have an annual tax on those gains, and sometimes even those phantom gains, which we'll talk about as well. And then it can have impact on other things like Social Security and Medicare based on interest and things like that. Now, the tax deferred bucket, why do we want to use that? Sometimes, people look at it like when people make extremes, you have to really be careful, because people say, well, I just don't want to pay, too much taxes, so I'm going to do everything tax-free or whatever. But there are some things to say, like if you have higher income today, using a vehicle like this can lower our income, put money in a savings vehicle that we can grow for retirement. And then we just have to know we have to do some tax planning later. So don't get so caught up in the tax thing that we avoid doing some things today that can lower taxes as well. It is going to grow tax deferred. And one of the big things you hear about a lot is the employer match. Now, I can't tell you how many times I run into this where people get confused about what the employer match is. 3% is usually what, kind of the norm for a lot of them. There are some that are more. And if you have that, then great for you. But it doesn't mean that's all you can contribute. You can contribute much more than 3%. That's just what the employer match is. So I've had people say, yeah, I'm doing the max. And I'm like, how much are you putting in? I'm doing the max. And then we actually look at it like they're actually only doing 3%. So you're doing enough to get the match, but you're not doing enough to put more money in that you're going to actually need to be able to fund retirement. So be careful about that. So again, it reduces your taxable income now. So this is one of those things where you're in your higher earner years. That's where you might use this to lower income. Automated savings. I always like, let's make it easy. The nice thing is you can tell your HR department at work, say, hey, I want to do 10%, and you get that match. It just comes automatically out of your paycheck and you don't have to worry about it. So that's really nice. Now, if we are putting money in tax deferred, we have to be careful, because then it means later on we're going to have a tax burden, and we have to be careful what that tax burden could be. And even if we don't need that money, it has to come out anyways at age 73 and beyond as required minimum distributions. If we try to take that money out early because we need it, we're gonna have early withdrawal penalties of 10% as well. So we have to be really careful when we're touching these retirement accounts. And we have to be aware of the potential tax burdens down the road. Tax-free, why do we want to use that? Because we want tax-free growth. And then when the money comes out, it's already been taxed earlier, so it's going to come out tax-free. Gives us some flexibility in retirement. I had one person I met with a couple of years ago. She needed to get a different car, and she was, didn't have an advisor. I was, trying to start a relationship with her, but she didn't have an advisor at that time. She actually went and did a huge IRA distribution from her tax-deferred IRA and bought the car with cash. Well, the problem is it came out of her IRA, that's counted as income, and it caused her to go up into the next tax bracket. And it was a big tax issue for her because she didn't know that. So, maybe that's where we pull from tax-free or from taxable instead, and then we don't have to make a big mess of things because we just didn't know. Gives us some flexibility, like we said. And again, if you're worried about taxes going up in the future, I'm personally thinking they will. This gives us a hedge against that because we can pay taxes now rather than paying it later at a higher rate. What do we have to know about it too? It gives us some tax-free income if we want in retirement, which is really nice. No RMDs have to be dealt with in the future. This is the best for your heirs because they inherit it. They don't have to worry about that tax burden as well. Now you're going to be paying taxes today, so it's not going to cause us to lower our taxable income today. And there is some contribution income limits we have to be careful of, as well as how much we can put in per year. So we have to be careful that, if we make too much money, that we understand that, maybe we can't contribute a normal way into this bucket. Now there's some other ways, backdoor, things like that we can do, but we have to be careful because if our income gets too high, maybe we can't use this vehicle the right way. So now what we're going to do is we're going to fast forward and say, now we're in retirement. We kind of have a basic understanding of our 3 tax buckets. And now we're going to have to start pulling money out of those tax buckets. And now we're going to kind of talk about what do we have to know about that now as we move into retirement. So now we've made it to retirement, and it's time to start pulling from our tax buckets for income. But before you dip into these, there are some key considerations to keep in mind. With taxable accounts, you're taxed on the gains each year. So when you take out money, you may owe capital gains tax depending on how much you take out and how long you've held the investments for. For example, let's say that you bought Apple stock 2 years ago, and that Apple stock was $50 per share and you bought 100 shares. Now, 2 years later, today we're going to go sell those shares, and those shares are now worth $100 a share. You may owe a capital gain on that sale of those stocks. Some key points to consider: be careful using mutual funds in this bucket. Why? Because you may not even touch these investments, but the mutual fund managers themselves are actively trading throughout the year to maximize returns. And at the end of the year, if it's something called a phantom capital gain, where you have to pay tax on it even though you didn't take a distribution. Another reason why retirees need to understand this bucket is when they sell real estate. It's important for them to understand their cost basis on the home, which essentially is what was the purchase price plus any capital improvements minus the sale price, and see if there's any potential capital gain in that situation. Remember, every dollar inside this bucket, when it's withdrawn, is subject to income tax. This is where required minimum distributions, or RMDs, come into play starting at age 73. Now, Uncle Sam has been patient this whole time, letting your account grow, but now he expects to get his share here. Now, these RMDs are ticking time bombs in retirement. They start at age 73 and get bigger each year. When do they stop? Either when you run out of money or you pass away. Oh wait, actually it doesn't stop then, because when you pass away, your children will start picking up the tax tab for you, and yet they only have a 5 or 10 year period to pay taxes on the money that's inside of this account. So let's say you have enough monthly income. Do I still need to take a monthly distribution at age 73? Yes, they are required. So what are your options? Well, you can put it into your savings account, but then we have that problem with inflation where it won't grow that much. But what if you want to reinvest that money and keep it growing? The IRS will make you pay taxes when we take the money out, but during RMDs, we cannot move it from the tax-deferred to tax-free bucket. Instead, if we want to reinvest it, it must go into the taxable bucket, and then it becomes subject to taxation again. Also, as RMDs come out, they will cause your Social Security to become more taxable. As much as 85% of your monthly benefit can be taxable. And if your income gets above $106,000 for a single filer or $212,000 as a married filing jointly, you'll have to start paying a Medicare tax, so to speak, called IRMA. This means your Medicare Part B and Part D premiums will increase. So we're going to start paying our taxes to Uncle Sam, and we're going to pay some more taxes, and we're going to pay some more taxes, because that's what it looks like and that's what it feels like when we're paying taxes to Uncle Sam. So let's take a look at the tax-free bucket. Let's start taking income out of this bucket. That's right. The good news here, there's no income tax on these withdrawals out of this bucket. As long as you follow the rules, you get to keep every dollar. Uncle Sam doesn't even get a cut of this money in this bucket. So if you pay taxes earlier and then contribute to the tax-free bucket, when it comes time to take money out, we won't have to pay taxes on this money ever again. Neither will our children if they inherit money in this tax bucket from us. They will not have to pay taxes on this one as well. All right, so I wanted to show you what it looks like to put money into the tax buckets as contributions, but then I also wanted to show you what it looks like to take money out of those buckets as distributions, so we can really understand the different tax considerations in retirement and be aware of them so we can keep more of our hard-earned money. By strategically pulling from each bucket, you can balance your tax burden and manage income effectively in retirement. Let's aim to keep Uncle Sam's bucket as light as possible. All right, so again, we want to make sure you understand how these tax buckets are going to work in retirement when we start taking income out. Now, right now, 70% of people have money in tax deferred, which means it has not been taxed yet. So they're kind of rolling the dice, hoping that they don't pay too much on it right now, but that's where a lot of that money is. 20% in taxable, which is also at risk of going up in taxes as well, and only 10% in tax-free. Now, I realize a lot of people say, well, Roth wasn't available when I was working. And yeah, it didn't really come out till like the 90s. And just recently with Secure Act 2.0, didn't really even make it more available in employer plans. So I get it. But that just means we have some planning we have to do, especially for nearing or into retirement years. Now, where do Americans invest? Most of it's in those employer plans. 70% of it's tax deferred, $25 trillion. I don't know how many zeros that is, but it's a lot. 401ks, IRAs, 403bs, 457s, SEPs, simples. A lot of it is in those accounts right now, which means we're kicking the can down the road. We're going to pay taxes on that later. Now, one thing we have to be aware of is our national debt. $36 trillion right now. We just passed that. So huge number. And we have a spending problem as a country. The problem is when we're spending and we have this much debt, we have to raise income to pay this debt. And our number one source of income is our taxpayers, which means you and I are going to be dealing with this. And the most likely places they'll be looking at increasing taxes, which is what they've been discussing during the election campaigns, is the tax deferred and taxable buckets to try to raise more taxes. So if they do, that's where it's going to hurt us a little bit, because now the money we thought we had, it's not going to go just for us. It's going to go to Uncle Sam. So again, the goal is to get more tax diversified. As you can see right now, we're heavily overweighted in tax deferred as a country. And most people I talk to, when I see their statements too, it's mostly in tax deferred and not much in Roth, maybe a little bit, but not much. We have to get more tax diversified so we have a little bit more control where we can get our income from. Now let's look at our federal marginal tax rates. Going back to 1913, you can see here, went up into the 70s and went back down. Now, right here, you'll see President Reagan here. He wasn't a president back then. He was actually an actor in California. And if you actually try to find his movies, there's not a lot of them because he only did 2 a year. He got paid $100,000 per film. And they asked him, why didn't you do more films? And he said, well, unfortunately, at that time, the tax brackets where they were, $200,000 a year, that was the highest part of the bracket. So if he did any more income, all that money would have went to the state of California. So it wasn't worth it. So 94% tax rate. Now, again, doesn't mean everybody was paying 94%. It just means that's what the highest people were paying. So extremely high tax rates, 90s, 94%. In the 70s, it was still in the 70% range. And of course, today, highest is 37%. Now, if you ask people today, do you think taxes are too high? They're going to say yes. They're going to say it's way too high. But if you look at historically, we're not high compared to historical. So again, we just saw 36 trillion in debt. Is it likely that this could go up a little bit? It is likely, even if it's like a small percentage, 3 or 5%. It might not seem like a lot, but it could mean a lot to the everyday retiree, because that's a big chunk of money just went away that you thought you were going to be able to use for your own retirement. So that's where we have to be really careful. So when we're planning for income, we have to know, how does our money get actually taxed? So 401ks, IRAs, annuities, pensions, that's all going to get taxed as ordinary income. Wages, if you work part-time, ordinary income. Social Security, ordinary income. Bank accounts, CDs, ordinary income. Roth IRAs, Roth 401ks are going to be tax-free because we already paid the tax on that. Life insurance loans, reverse mortgage loans going to be tax-free. And then obviously stocks and mutual funds are going to be capital gains tax rates right now. So we got to make sure we understand, if we're getting income, where we're getting it from and how's it going to be taxed. Now, we use a progressive tax bracket in our country, and it's important to understand, because this is one of the things where a lot of people get confused on. They go, well, I'm in the 22% bracket, so I get everything's at 22. And what they don't really realize is, like the first 0 to 22,000 is taxed at 10%. And then 22 to 94,000 is taxed at 12%. And then let's say you have 100,000 in income, 94,000 to 100,000 is taxed at 22%. So it progresses. Each chunk of money is progressively taxed. Now, if you have $100,000 of income, you take a $10,000 distribution out of your IRA, and you add $10,000 of income, that $10,000 is going to get taxed at 22 now, because that's where we are. Now, we're going to talk about this more too, because it's really important to understand how the progressive tax bracket works, because part of our proactive tax planning is understanding how this works and where is there opportunity sometimes to pay now rather than pay later, so we can pay lesser taxes in the future. Now, in 2026, the Tax Cut and Job Act is going to end. That originally happened in 2017. So it lowered our tax rates. It's going to go up a couple percent each of them. The other thing that's going to happen is our standard deduction is going to go down as well, which is actually going to cause us to have more taxable income. Now, they've talked about extending it or making it permanent. Until that happens, we have to go with what we know. And right now, it's set to expire. So could it be extended or made permanent? Yes. But again, we don't know that for sure. So we're going to go with what we have right now, and we're going to assume it's going to expire until we hear differently. But we have to be aware of that, because if it does happen, your tax bracket rates are going to go up, and then your standard deduction is going to go down, and then we're going to have more taxable income, and we're going to have more taxes, which means we're going to have less for us and more for Uncle Sam. One thing we have to be aware of too is that retirement tax cliff, where what happens is, as RMDs start kicking in at age 73, and maybe you don't even need the income, but you got to start taking money out because IRS says you have to. And when you do, that could actually unexpectedly push you to higher tax brackets. And I've seen it a million times, even in the last couple of years here, where retirees are getting close there and they didn't realize these RMDs are going to be all this extra money. We'll talk more about RMDs in a moment here. But it can really do some devastation. That's why they call this the ticking time bomb, these RMDs, because it's going to wreak havoc and actually take away more of what you worked so hard for and give it to Uncle Sam. So RMDs required, have to do it, minimum amount, distributions, have to do it every year. So, these are some quick looks at things. So at age 73, if we take some money out, there's a life expectancy table we have to be aware of. Say we have $1 million, we're going to have to take out about $38,000. Now, let's say, hey, Kurt, I don't need that money. I have a pension. I have, 2 Social Securities, and we don't need it. Doesn't matter. It has to come out. So then we're going to add this income to our income, and it's going to cause our taxes to go up, and this to get taxed more. And then this is going to have an impact on other things too, which we'll talk about. So you can see how, this is extra income per year, and it gets bigger because the life expectancy table gets bigger. So there's going to be a bigger amount coming out each year. And let's be frank, we're assuming it's still going to grow a little bit too. We're not going to just, bury it in the backyard and just have it be nothing. We're going to want it to grow a little bit too. So it is still going to grow, and then it's going to, come out in bigger amounts each year. Now, what happens when these RMDs start going off is we create a Social Security torpedo of taxation, where now your Social Security gets taxed more. Now, before this recent election, a lot of people didn't even realize your Social Security gets taxed unless they actually see it get taxed, and they get really mad when they see it. But they weren't aware of that. They thought, well, I paid tax to put money into Social Security. What do you mean I'm paying tax when I actually get it? That's not fair. And this is where people get really upset. But it actually does get taxed. Now, the one thing to be aware of too, these tax rates here have not been changed since they were established in 1994. No inflation adjustments at all. So our Social Security has a cost of living adjustment. Our actual living expenses have inflation on them, our medical expenses, things like that. This has not changed in 30 years. So you can imagine these are not helping us anymore. So most people, 85% of their Social Security benefit is considered taxable income for most people. Now, if you have lesser income, yeah, you might not have it, but then you also don't have a lot of other assets. But most people, it's 85% of it is considered taxable income. And that's where people get really upset. Now, those RMDs, when they start adding to your income, it's going to cause your Social Security to get taxed more. And you're going to see how that can really impact things as well, because you're going to have less you can use of your Social Security then too, because of this. Now, IRMA, income-related monthly adjustment amount, which is Medicare premiums. If your income gets too high, and which those RMDs cause for a lot of people, it can cause your Medicare IRMA to kick in, which basically means your Medicare Part B and Part D. B is part of the original Medicare, Part D is part of your prescription drug plan. Those premiums are going to go up because of income. And it's a lot. And it's a cliff too, by the way. So, and it's before deductions and everything too. So you have to be aware of the difference of income that they're using to calculate this versus income they're using to calculate other things. But it can be pretty devastating. I mean, it could be, $8,600 per person, which, that's $17,000 a year of extra Medicare tax, so to speak. So I would say Uncle Sam, we try to disinherit Uncle Sam, but we also want to avoid his friend Aunt Irma, because Aunt Irma, she's usually right behind Uncle Sam. If our income goes up because of taxes, then she comes in here and says, sir, let me just let you know, you're going to be paying more for Medicare now because you have more income. So when we talk about taxes, I always use this analogy of the windshield and the rearview mirror. Now people will say, well, why didn't my CPA talk about this? And don't blame your CPA. Is people have this wrong mindset of what they're doing and their capacity and things like that. CPAs and accountants and tax people, they're looking backwards 12 months. So they're looking in that rearview mirror, looking backwards at the last 12 months, and they're going to file your tax return compliantly, accurately, and making sure they get the best return for you based on what's happened in those 12 months. They don't have the time to look forward, most of them anyways. They don't have time to look forward and say, okay, where are your taxes going? So what I do, I look forward through the windshield and I say, okay, where's your income coming from down the road? Where we have that money sitting in the tax buckets? Where is the tax brackets going to be? Where is the tax law changes happening? What other things are happening? So we can understand where those taxes are going. And as we're going down this road, does it make sense sometimes to maybe pull off the side of the road and start paying tax earlier at a lower rate than what it could be down the road? That's what the big difference is. And if you're not doing it proactively, you're just going to say, okay, once I get to my destination, I'll pay whatever it is. And it's going to be a big bill because we didn't pull over and do it earlier. Now, we'll talk about this in much more detail in a future episode actually coming up. We're going to talk about what a Roth conversion is, why we do it, how they work. But essentially what we're doing is when we do it, and it has to be usually before RMD start or above and beyond what the RMD is, which is what people get confused on. So if your RMD is 40,000, you'd have to do more than that on top of the 40,000 to do this. So that's why you usually want to do it before RMD start. But what we're doing is then we're just going to grab money out of this pile of money in this tax deferred bucket. We're going to take it out. And when we take it out, and it's a distribution, we're going to give whatever percent to Uncle Sam. And then we're going to then drop it into this bucket tax-free. So once we pay tax on it, now it's tax-free. And then it's going to grow tax-free and come out tax-free. So for us or for our kids or whatever, it's going to be tax-free now. Uncle Sam gets his cut. So we're going to talk about this a little bit more too, but we can decide how much tax to pay on it if we do it proactively. If we wait till it has to come out, it has to come out. It's too late now. But if we can do it proactively, we can decide to pay at a lower rate than what Uncle Sam's going to want us to pay at. That's what's key. So having proactiveness is going to be huge when it comes to tax planning. Again, that progressive tax bracket, here's what that looks like. Again, if you're in the 22% bracket, maybe you have some room in that bracket yet. And then we can talk about, what do we do with that? So here's an example. The visual showing these glasses here. They have wine in them. So you can see that, this one's filled, this one's filled, this one's filled. We get to 24, it's only half full. Well, if we are worried down the road because we're looking at our tax journey, our tax map, and we see that we're going to have some extra income, our RMDs are going to start coming out, and we're going to go all the way into this bucket or glass, we might say, hey, each year until then, let's start filling up this glass. I'd rather pay at 24% than paying at 33% when the Tax Cut and Job Act goes away, or even more if they raise taxes. What if they raise that to 5%? So now it's 38%. I'd rather pay at 24 than 38. So I'm going to do a little bit at a time, and I'm going to pay at 24 instead of paying later. And that's the progressive tax bracket. That's the proactive tax plan that we need to be doing to make sure we can save on taxes. Now let's look at two case studies here. Here's Terry, the taxpayer. Terry is a good American. He thinks, I got to pay my taxes, but I just don't like, writing that check every year to pay taxes. I just don't like it. So he's not going to be proactive with his tax plan. So let's take a look what happens with Terry. So Terry's got $1 million IRA. We're going to assume that he's in the 20% tax, just for a round number here. And we're going to assume his account's going to grow at 5%. So when that money starts coming out as RMDs, he's going to be paying close to $300,000 in taxes just on the RMDs alone. Now, he doesn't need all this, so he's going to reinvest it. You remember, we can't, once we pay tax on an RMD, we can't put it into the Roth. They won't let us do that. So if we pay tax on the RMD and we want to keep it invested, we can either put it in the bank account, which doesn't grow really at all. We can put it back into the market, into a taxable bucket, like in a brokerage account. But then that's going to grow, and we're going to get taxed on the growth. So we're going to pay tax on that money again. So we have to be aware of that. So that's the RMD reinvestment tax. Now, when he passes away, his kids inherit that account. Remember, whatever is still in that bucket has to come out and get taxed. And for kids, it's a 5 to 10 year period. It has to come out, and it's on top of their current income, which if they're in their higher earning years, could be a higher tax bracket for them as well. So then they're going to pay, another $267,000 of taxes on that. Add that up, it's close to $700,000, and we're not including Social Security or even Medicare tax on top of that. With Social Security, could easily be over $1 million then. So that is what happens because Terry decided to not do any tax planning. Now let's look at Roger, the Roth converter. So he's happy because he was proactive. So let's see what happens with Roger. So Roger has $1 million IRA as well, 20% tax bracket, tax liability, 5% growth. He's going to move money over proactively into his tax-free bucket from the tax deferred. Now, this is a very simple explanation. It's actually a lot more going on than this, but he's going to proactively move that money over so he can get rid of his RMDs. And then he won't have to worry about putting it into the taxable bucket. He won't have to worry about his kids inheriting anything in that tax deferred bucket. And then he'll just pay whatever that is to move it from tax deferred to tax free in his Roth conversions. And then that will actually, once he does all that and gets past all that, it'll actually help with his Social Security and his Medicare as well then too. So being proactive can have a huge difference as far as longevity and as far as comfort and getting rid of anxiety and stress as well. So again, got to make sure it makes sense for you, but it can have a huge impact. So one thing we always tell people is tip your waiter, make sure they get tipped. And maybe they don't get taxed on their tips anymore either. But tip your waiter, and let's not tip the IRS, because right now Uncle Sam is your number one benefactor, like we said in the open, but we don't want that to continue to happen. So we want to make sure you can use that money more for your retirement needs as well as your kids or even charity. And we got to be proactive in doing that. So we have to, by knowing our tax brackets and our tax buckets, we can know how we can contribute to those accounts while we're working. And then when we get to retirement, we can know how do we get money out of that safely and have a proactive plan to get it in the right buckets so we can actually not pay too much in taxes. Now, you can't just run away and not pay taxes or you end up in an orange jumpsuit. But if we do it proactively, we can keep more of what we work so hard for. So as we like to do every week, is we like to teach. Taxes is really confusing. I think sometimes even when I try to even simplify it even more, people are like, it's so much to think of. And that's why I'm here to help. If you'd like to get an idea more of what your tax situation looks like, again, the windshield looking forward, we do that tax map where we go, let's look at your situation, your income sources, where your money's held right now in the tax code. And let's look forward and see where those taxes are going and what can we do proactively to pay lesser taxes over the future so we can, keep more of what we want to. And that's the proactiveness. We got to understand where we're going, and then has to start doing some things daily or annually to make sure we can prevent paying too much in taxes. So we have this resource if you'd like to get involved. There's a link in the show notes right now. Our team is putting it in right now. You can actually get access to get that tax map where I'll help make that for you and kind of show you where your taxes are going and help you understand that. And then show you here's a couple things you might want to start thinking about doing. And it's just education. So there's no backhanded sales pitch or anything like that. We're just trying to teach you so you can understand how we can minimize Uncle Sam in your life and keep more of what you work so hard for. So again, want to thank you for joining me for this journey of taxes. I know you're probably like, oh, taxes are so boring, but it's so important to understand where you keep your money and how important that is so you can actually make sure you can actually use your money for you and your family and your goals for retirement. So thanks for joining me again for this week. Again, we are live every Thursday, 11 a.m. on the East Coast and 8 a.m. on the West Coast. Thanks a lot for joining me again for another episode of Retirement Rescue Weekly. Until then, have a great week. Thanks.